Hello and welcome to this edition of All About Your Company. Today we're going to be talking about a small lender, an nbfc, where the stock price has doubled over the last few months. Also, there's been a 5% acquisition by promoters in the company. We're going to be talking about Paisalo Digital. And if you look at the kind of run the stock has had, it's a phenomenal run, at least in the current financial year. Today also the stock is perked up 2.5 to 3%, and that the kind of gains that it continues to clock is quite strong. In terms of what the key pieces are that keeps us interested, one is the promoter buying. 5% is what the promoter has bought over the last few months in the stock. The guidance that the AUM is set to double in the next 3 years looks strong, even on the base that they currently are at. And the credit costs, they are well under control. This one has an NPA of less than 1.5 across cycles, 1.5% on the GNPA number. And we'll look at and dissect some of those numbers going forward. Let's take a bit of an overview. 1992 is when this one was incorporated originally. It's a registered NBFC engaged in the small ticket MSME loan space. What it essentially does is it currently has a market cap of around 6,700 crore. The story is that we've got 60 crore Indians in the rural semi-urban space who need credit, and banks don't deliver that to them, and therefore Paisalo has taken it upon themselves along with many other NBFCs to ensure that they are the lenders of last resort to some of these people. The difference, of course, is that Paisalo is able to control credit costs along with it. The average ticket size that they currently lend to is 50,000 to 5 lakhs, and they term it as it's small enough for borrowers to technically repay and large enough to change their livelihood. They use technology to underwrite, disburse and collect, and that's worked effectively for them from an asset quality and a collection standpoint. So that's something to keep in mind. In terms of loan categories, I'll start off with the smallest one, the small income generation loans. This is, of course, the core and the original business of the company. It's essentially loans to micro enterprises to generate income. Some of it is working capital, a large part of it is working capital. Average ticket size is smaller, 50,000 to 2 lakh rupees. Around 25 or a quarter of the portfolio is in food and hospitality within this pack, and agri and allied is around 14%. Then there's vehicle and mobility, and this is one of the faster growing as well. They've introduced better products and more products in this one. That's the second pillar. It's to buy income generating vehicles only is what they disburse to. Two-wheeler, three-wheeler, small commercial vehicles, used cars and the like. Borrower uses it to fund his new business, and that's in the mobility space. Then there's MSME and equipment loans. Again, what you will see is a strong tilt towards income generating kind of businesses and assets. That's what the tilt is. Larger for small entrepreneurs and equipment buyers, that's what the loans are for. Medical equipment, industrial equipment, agri equipment, fuel, alternative fuel vehicles, EVs and the like, hybrid vehicles. Ticket size is up to 5 crore for corporate and MSME loans, but those are a small composition of the overall book. In fact, 92% of the book approximately is secured, and that's why you've got a very large secured segment against physical assets. So that's broadly the way in which the product is structured. In terms of the other piece, there's one piece outside of this also that Paisalo does. It has a relationship with SBI, and this is a business correspondent relationship. Basically, it behaves like a customer service point for SBI at 970 plus locations. And this gives the company access to the bank's network, credibility, as well as lending operations. And to some extent, it also has a co-lending arrangement with SBI on that count. So, yeah, and of course, just not with SBI, with others as well. So there's a co-lending arrangement with SBI as well as others with regard to this. And when they originate the loans, SBI funds 80%, the company retains 20% of the lending, plus on top of it, they earn a fee. We'll try and understand some of this as well going forward, but broadly, this is the way. In terms of presence, let's talk about how large this is and how well spread it is geographically. There comes one small risk as part of this. Let's quickly look at that. When you're looking at Maharashtra and Delhi, it's around 50% of the book. So concentration is high. Even though presence is in 22 states, you've got Maharashtra, Delhi, Haryana. So Delhi, Haryana combined is around 43% of the book. If I throw in UP, that's 57% of the book. And thereafter, if I throw in Maharashtra, it's 80% of the book. And with Rajasthan, it's 92% of the book. So therefore, what you're seeing is that the concentration is elevated. Other states is around 8%. Branches and touch points, they've got around 5,300 touch points currently, with around 422 branches, 3,381 partner outlets where they distribute products from, and they have a tie-up with 1,500 business correspondents, and they have a customer base of around 1.6 crores. So it's a large customer base as well. Let me quickly also take you through the financials. And the growth has been strong, mind you. When you're looking at the last 3 years data, you'll see, last 4 years data, you'll see a 31% growth CAGR on the net interest income number, which is technically the top line of the company. Excuse me. Very, very close to the AUM growth as well. So not very different from that. When you're looking at the operating profit as well, you'll see a 29% growth there as well. And mind you, the base we've taken on operating profit is essentially PBT, which is profit before tax plus impairment. That's the basic calculation we've done for operating profit for the first couple of years. Thereafter, it's a reported number. Excuse me. When you're looking at provisioning, provisioning has been on the lower end, even though FY23 was an elevated base. Currently, you're sitting at around 42 crore in terms of provisioning. So that elevated base actually suppressing the CAGR number, which you can see on top. But nonetheless, this is fairly controlled. And we'll look at those even in terms of the NPA ratios as to how they've evolved. Last off, you look at PAT. The PAT growth has been strong. It's been a 31% PAT growth. Even though there's been some choppiness with regard to the rate of growth, right? Deflated base of FY23. But what you're seeing is a steady upward tilt with regard to profitability. Now, in small NBFCs, this has been tough to get, especially if you're lending to the MSME sector. And therefore, that's what really stands out where Paisalo Digital is concerned. Why the word digital, by the way? They use a lot of technology as part of their lending. So that's why digital. Let's talk about the balance sheet now. The growth has been 31% on the AUM front. Disbursements have also grown at a very, very healthy clip as a result of that. Excuse me again. And capital adequacy currently sits at just about sub 40%, which means that it's very well capitalized and therefore no concerns whatsoever from a capital raise perspective. But we'll try and get a sense, excuse me, as to how this will evolve. If at all that growth of 24% odd were to continue, how quickly do they need a fundraise is what we'll try and ask the management on. Let's talk about operational metrics now. When you're looking at the yield on advances, it currently sits at 16 to 17 odd percent. And therefore, and a couple of years, it's gone up to 18% as well. Quickly, let's move to operational metrics, please. And what you'll see is a 17% yield on advances. Margins have been around the 6 to 7% band. That's broadly the band of margins. Cost of borrowing has been between the 10 and the 11% band. Broadly, it inches upwards in bad rate cycles, but broadly, this is the trend. I'd also want to understand whether there's any lever of cost of borrowing coming down. If that were to happen, obviously, that would add to the margin number. ROAs have again been very, very strong. Sometimes 4.5%, but otherwise, it's been above 3% consistently. So when the stock was trading at, say, one and a half times book just before this rally, it's justified because the way in which the ROAs have always remained quite stable, there has been a merit to the fact that the stock has doubled over the last few weeks or months. Let's talk about asset quality now, and you'll see that there's lack of choppiness in the asset quality. There's plenty of comfort, 1.5% being the peak in FY22 with regard to the GNPA ratio. NNPA ratio also very similar trend you'll see, of course, lower than GNPA, and broadly the NNPAs also have been very, very stable. No GNPA or NNPA ratio above 2%. That gives you a lot of comfort that the lending is solid. When you're looking at the return ratios, though, we saw deflated ROEs at the start, which is FY22-23 of the period that we are covering. Thereafter, we've seen a bit of a pickup. So 13% odd is where the ROCE's numbers currently stand at. The goal is to get to around 15% in terms of ROC. And that may well happen very quickly as the numbers start to play out. Let's talk about shareholding pattern. Shareholding pattern had gone down from 50% to 42%. Thereafter, for promoters. Thereafter, now, at the end of FY26, it's inched up to 47 and now it's 49% because the promoters have continuously kept buying stock. So we'll try and get a sense as to whether this is where it'll lie or whether there is more to it in terms of promoter buying. FIs have trimmed their stake, DIs have also trimmed their stake to a certain extent, and public holds around 40% of the company. Valuations, and we've done this on the basis of math, simple. 1800 crore is the current book value, right? That's book value, by the way, not the valuation picture, that's book value. The trailing 12 months price to book is around 3.7 times. The trailing 12 months PAT is around 237 crore. The PAT growth estimated is at around 24 to 25% next 3 years. So PAT will double from 230 to 460. That's the hope, right? And that's the guidance. The trailing 12 months FY27 price to book value based on trailing 12-month PAT, I beg your pardon, is around 3.4 times. So it could be between 3 to 3.3 approximately if you're looking at the FY27 price to book. So that's how the valuation picture is stacked up. Is it expensive? Yes, seems like. You've got 24%, 25% growth, stable asset quality though, and trading at around 3.5 times book. That does seem a little bit expensive, and therefore we've given this a neutral view, a cautious view. Also, you've seen a stupendous run-up on the stock price. That's the other thing you want to keep in mind. Let me, though, bring on board Santanu Agarwal. He's the Deputy Managing Director at Paisalo Digital, joining us this morning. Santanu, great speaking with you again. I want to reboot the conversation by trying to understand from you this 24 to 25% growth clip over the next 3 years that you're anticipating. What are the levers to that growth? You've launched a few new products. What's the kind of traction that some of those products are seeing? Can you give us a sense?
Hi, good afternoon. Thank you for having me on the call. So, we are on a 3-year strategic roadmap where we are pivoting and saying that we are going to be doubling our AUM, PAT and revenue over a span of next 3 years. There are 4 key pillars that we have identified for the same, which is our last mile scale, which is transitioning now from a high-tech, high-touch model to an AI-based lending model. The second is a broadening of the product suite, which is we are scaling our MSME and small income generation loan product suite, which I'll just explain in a bit. And we are now utilizing our expanded geographical expansion that we have been undertaking for the last 3 years and capitalizing on the distribution and the touchpoint expansion that we have done over the last 2 years. Fourth is the optimization of the cost of capital that we have done, where you'll see that over a span of last 4 years, we have been able to bring down our cost of funds from about 12% to now 13.3%, which will combined give us the strategic roadmap achievement of doubling the AUM, income and PAT. In terms of the product expansion, primarily we were operating out of 2 categories, which is our micro enterprise loan category and our our micro enterprise loan category, which is also small income generation loan category, and our MSME, SME opportunity, which broadly had about 6 to 7 sub-products amongst them, where Vikas loan being the one where you start off with, and typically you end up at the end with a Udaan loan. In the last quarter itself, we have been able to add 6 new products to it, which is medical equipment, industrial equipment, alternative fuel-based mobility, small commercial vehicles, agri equipment, and 2-wheelers. For medical equipment, we have finalized about 5 OEMs, which is Philips, Mindray, Horiba, Salmon, and Edgesoft. For industrial equipment, we have done Kirloskar, Mahindra, Reeves Cotton, Etcher, Jackson, Perfect Generation, Industrial. For alternative fuels, we have been able to do Tata, Wari, Luminous, Servotex, Statcom, Eastman, Loom, Livguard, Bokaya. For 3-wheelers and SCV, we have Mahindra, Piaggio, TVS, Bajaj, Montara, Altigreen, Eka Mobility. For agri equipment, we have Escorts, Shaktiman, Masicho, Preet, Dashmesh, Jaswant, Apollo, and Champion. And for 2-wheelers, we have Hero, Honda, Suzuki, and Yamaha. Broadly taking our existing product suite from a 6-product suite to doubling it to now about a 12-product suite.
So then this and my understanding is that this 25% loan growth guidance also doesn't include co-lending.
Yes.
Why then 25% when you've done nearly 30+% last 3-year CAGR? Shouldn't it be stronger in terms of the guidance or the aspiration?
So when you're doubling your AUM over the span of next 3 years, we do project that it will be closer to 30% only. In fact, to be exact, it is going to be about between the range of 30 to 35% with the average year-on-year growth at being, 33% for us to double the three things in the next 3 years. The co-lending is not included in this primarily because on 1st January 2026, RBI's new policy on co-lending got into effect. And we have our compliance, we have banks compliance both put into place. And we have based this entire growth guidance, excluding co-lending. Anything that comes from co-lending post the compliance of RBI is met both at our front and at the bank front is going to be an additional growth parameter that we have not built into it. So we are just keeping ourselves slightly conservative by not adding co-lending growth in the strategic roadmap.
Okay, but you'll still do 30 is what you're saying.
Yes, absolutely.
Okay, got it. And with regard to any fundraise at all in the pipeline, your capital adequacy is very healthy, but you've traditionally always kept it very elevated. Any reason for that, and any fundraise in the pipeline therefore?
So, my father started the company back in 92. He got listed on 1996 in Ahmedabad, Delhi, and Kanpur Stock Exchange, raised about 1.5 crores in his IPO, followed by an SPO in 2009, followed by an FCCB about 4 quarters back. So if you traditionally look at how we have been doing business for the last 30 odd years now, we have primarily focused on two parameters. Number one, that it's a collection business first. So we are heavily focused on the collection side of the business. And number two, that is that we are okay with loss of profit, but we are not okay with loss of capital, which is why our capital adequacy base has always remained high. The advantage of having a high capital adequacy base is that we are never in the market to immediately raise capital at a subsidized price, thereby being a disadvantage for the existing shareholders. And we are coming into the market when we are strategically priced in and we are ready with our strategic roadmap, which we typically follow since inception. We have had a 7-year doubling cycle for about 7 years. Then we had a 5-year doubling cycle. Now we're getting into a 3-year doubling cycle. And then we'll see how we go from there. So that prevents us from raising capital at any given of time, and we can really price in when we want to raise the capital. In terms of our existing raises, we don't have anything priced in from a capital market point of view. We do have a 900 crore debt issuance, public debt issuance, which we are coming up with, which our board gave our approval last quarter. So we are hoping to start that sometime this quarter for sure.
Any scope of reducing cost of funds or working on that number?
So, we have guided a cost of fund of about 10.5%. We're at 10.3%. We have maintained the same guidance for this year also, because while we were making our strategic roadmap, we took that last year guidance as the base guidance for what are the basic parameters that we need to continue for the next 3 years in order to achieve the growth in the profitability, revenue, and AUM numbers that we need to do. So we have kept the same guidance for the next 3 years. Any further reduction from any guidance, we are going to adjust the guidance on a quarter-on-quarter basis whenever that happens, and basically change update the strategic roadmap accordingly. But for the timing, we are pricing it at about 10.5% in our strategic roadmap.
Okay, point taken. And with regard to the fee income, that's come off versus FY25. Is co-lending one of the reasons for that? How does co-lending as a model work? How much do you make in fee in case of a, say, 1,000 rupee loan? How much is the fee component, and how much is the interest component? How do you account for it? Could you give us some color on that?
Absolutely. So see, there are two models defined under co-lending. There is a co-lending model 1 and there is a co-lending model 2. Primarily, co-lending model 1 is a completely STP-based API integrated co-lending platform between the bank and Paisalo. Vis-a-vis co-lending model 2 is akin to a direct assignment model. So when you're doing co-lending model 1, let's say the bank is lending 100 rupees and the bank is giving their 80% of it at 100 rupees or at 10%, versus the NBFC, let's say, is giving their 20% at a hypothetical number of 20%. That gives the cost of capital to the borrower of about 12%. How we come to that 12% is that 80 into 10% is equal to $8, and 20 into 20% is equal to $4.4, which is, 12.4% is the blended cost which comes to the borrower. On top of that, NBFCs will charge processing fees because they are doing the end-to-end origination, servicing, collection, and also NPA collection in compliance with the banking guidelines and the RBI guidelines. So they are allowed to capture a servicing fee component, which ranges from a range of about 3 to 5%, depending on the asset class that is being underwritten, depending on the geography of the borrower that is being underwritten, and depending on what the credit policy of the specific product that's being underwritten at the bank level, at the NBFC level, which gives the borrowers average cost of capital at about 15.5-15% when the co-lending is being done under co-lending model 1. Vis-a-vis, when you do co-lending model 2, there is a fixed rate that is decided between the bank and the NBFC. So say the bank is lending their 80% at 10%, the NBFC will also end up lending their 80%, their 20% at 10%, and the bank will, basis on collection, give back a service charge to the NBFC, which can be again a similar number. So the difference between the two is that when you're doing the first model, you are able to have a completely STP-based process flow, API integration, which means that every single disbursement is being processed on a live basis, and it doesn't matter whether you are on a national holiday or the bank is having some down system, or the NBFC is having some API issue, or the NBFC's branch not function. It's a completely automated system. Versus on a co-lending model 2, you typically source, send it to the bank processes. It's typically between a 7 to a 15-day cycle. Although I've yet to see under the new co-lending guidelines how the co-lending model 2 is working, because we primarily have our arrangement with SBI and the co-lending model 1, which has worked really well for us.
Got it. And any drag with regard to the guidelines themselves? Does it pose to be a drag on this co-lending book of yours? Any regulatory risk from emerging from basis the guidelines?
So typically, we maintain a 25% industry exposure, or any specific industry that we are working under. You captured it extremely well at the beginning of the conversation, how our industry exposure was done. So internally, even if we are capturing the co-lending side of things, we are going to cap it at about 25% of the AUM that we have at any point of time. With regard to the drag in the co-lending guidelines, I feel that RBI has made co-lending model 1 even more feasible. And in fact, RBI wants to push co-lending model 1 over co-lending model 2. That's just my opinion. So we don't see any drag. Obviously, there is some additional compliance that we have to comply with our end also, and the banks have to comply with their end also. So that is just whatever time that's taking is the time that we are waiting for. But there is no drag.
And with regard to inorganic expansion, you've spoken about that on conference calls. You've spoken about how you're interested in it. Talk to us a little bit about ticket size. Talk to us about the nature of the acquisition. Talk to us about the timing of the acquisition, if there is any. Multiple, single, how are you looking at this?
So, in the last 30 years, we have never done any kind of personal loans. We have always believed that whatever lending we are doing should go towards aiding the livelihood of the borrower and should result in incremental impact in his income or the family income that is there. So primarily, we are looking for opportunities where largely the NBFC book is tilting towards an income generating loan, whether it is into a micro borrower category or an micro enterprise level category, or an SME category or an MSME category. We are not worried about that because we can accept that kind of broad borrower base into our existing book very well. Our staff are extremely well trained for that. But we are staying away from any kind of NBFCs which have a large tilt towards any kind of personal loan or consumption loan. There has to be some income generation on that. In terms of the opportunities, we have a mandate which we have given across to some industry players that are actively scouting for us due to regulatory guidelines and NDAs in place. I cannot say if and what opportunities we are evaluating at, but definitely we are evaluating all NBFCs which have a tilt towards income generation and income expansion rather than consumption or personal.
Understood. Okay. And with regard to your own increase in stake in Paisalo,
yes.
Are you happy with the current stake? Would you be adding more at all to your current stake?
So, we did a foreign currency convertible bond about $50 million about 4 quarters back. Of that $50 million, roughly $6 million has been converted, and we are positive that the $44 million can get converted over the coming quarters for sure. So, primarily, post that conversion of the foreign currency convertible bonds, the promoters are expected to reduce in terms of their shareholding by anywhere between 5 to 6%, not because we are selling, but primarily because the addition of additional shares that are going to get issued in the market. 40 to 50% is broadly a very good range that we internally feel we are very comfortable and happy with. So anything between 40 to 50% is what we are targeting in the next couple of quarters and maintaining the same.
Point taken. Okay, Santanu, thank you so much for coming in and speaking to us. The other piece that I did speak to Santanu about in a previous conversation a couple of weeks ago, viewers, for your context, is OPEX. You might want to go back to that conversation, quickly take cue of that as well, because operating efficiency will likely play out, and we spoke about that. But that's all the time we have on this edition of All About Your Company. Thanks so much for tuning in.